Hello folks, you must have seen these type of gaps on the chart and you could have thought how to trade these gaps properly. The gaps in the market occur when high impact fundamental news are about to arrive or when huge liquidity comes in the market. They are in the shape of buyers and sellers. Before starting this session, I will plead to all the viewers kindly like and subscribe the channel. So basically we are having three types of gaps. We will be starting from the breakaway gap. The breakaway gap is defined as the gap usually occurs at the completion of an important price pattern. At the completion of an important price pattern, which we can see below, here we were having a double bottom pattern, and while completing this pattern at this point, the gap occurred, and the gap also appeared while breaking the previous resistance. This type of gap, the breakaway gap, usually occur on heavy volume, and breakaway gaps are most often not filled and left open. So these are the criteria for a gap to be known as a breakaway gap. Let me show you its example on the chart. So here at this point, let me zoom it out a little in order for you to understand. We were having first bottom, then we were having the second bottom. So it is a double bottom pattern, and while completing this pattern the market created this gap. If we see to the left, we were also having a resistance point. So while breaking this resistance point and while completing the double bottom pattern, the market created this breakaway gap, and as we define its criteria, the gap is left open. The criteria for not filling the gap is that the gap will not be filled instantly, and later in the market it will surely get filled. And if the market approached the gap instantly, this gap will act as a support, and the market will bounce back to the upside. So whenever this gap appears, we can enter the market, we can open a trade, we will place our stop loss below the breakaway gap. So this way our stop loss will be less likely to get triggered. These were the example of the first type of gap. Now let's move toward the second type of gap, which is the runaway gap. The runaway gap is also called as the measuring gap. Somewhere around the middle of the move, prices will leap forward to form a second type of gap or a series of gaps called the runaway gap. So if we can see, it is also in the middle of the trend, in the middle of the move, the runaway gap appeared. This type of gap reveals a situation where the market is moving effortlessly on moderate volume. In an uptrend, it is a sign of strength, and in a downtrend, it will be a sign of weakness. And similar to the breakaway gap, the runaway gap will not be filled instantly. And if the market approaches this gap will not be filled and it will act as a support in an uptrend. So whenever the runaway gap appears, we can enter in the market, we can open a trade, and we can place our stop loss below the runaway gap. So what will happen? This way our stop loss will be less likely to get triggered in the market fluctuation. Now let me show you the example of the runaway gap. The runaway gap usually appears after the breakaway gap, and it appears at the 50% move or in the middle of the trend. So let me zoom in a little to show you the breakaway gap. I hope you can see the gap in between the two green candles. This is the runaway gap. It is an H4 time frame. So the gap was not filled instantly. It took the market 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12 candlesticks to fill the gap. So you can see it took the market 2 days. 12 H4 candlesticks is equal to 2 daily candlesticks. And after retracing back to the point where the runaway gap was appeared, the market again continued its bullish run. So what happens after the runaway gap? The market will travel as much after the gap as it has traveled before the gap. Let's see if this statement is correct or not. The market traveled this much before the runaway gap. Let me zoom it out a little. Now we will take it from this point to see exactly it has traveled exactly the same amount as it traveled before the gap appeared. So this statement was correct. The runaway gap, as we can see, is in the middle of the trend. So these were the scenarios of the breakaway gap and the runaway gap. Now let's move toward the final type of gap, which is the exhaustion gap. This exhaustion gap appears near the end of a market move, and this gap usually appears after the breakaway gap and runaway gap. So when the exhaustion gap appears, that is the point where it is indicating that the trend is about to reverse. As we can see in the illustration, once this gap appeared, the market formed a resistance, and then the market formed second resistance. So this is also a double top pattern, and afterwards the trend reversed. So when after all objectives have been achieved and the other two types of gaps, the breakaway and runaway gaps have been identified, the analyst should begin to expect the exhaustion gap. And when the exhaustion gap appears, we can anticipate a reversal in the trend. Now let me show you its example on the chart. So initially we were having the breakaway gap, then we were having the runaway gap, and finally at this point we are having exhaustion gap. Let me zoom in. This is exhaustion gap. The gap appeared after a strong bullish candle, and as it appeared after the breakaway and runaway gap, so we can anticipate that the uptrend is about to terminate and the downward trend is about to get started. As we can see, the downtrend got started after appearing of exhaustion gap. Again, at this point, I am indicating toward the exhaustion gap, which occurred, and nearly after its occurrence, the market made its high, the resistance point, then the market made an intermediate resistance, intermediate key term high, and afterward the trend reversed. So all the three examples I shown on the chart were of bullish scenarios, were of an uptrend. The first one, the second one, and the third one. And I think I did justice to this topic. So I will leave the bearish example of these gaps to all of you guys. Take it as an homework. Find the gaps in an bearish market. I will just show you the illustration on, let's say again the market created this double top pattern, and as we said, the breakaway gap is defined as the gap that occur at the completion of major price pattern. So major price pattern was the double top. This gap is not filled, and at least not filled instantly, and if the market approach this gap will act as a resistance. So we can enter the market, we can open a trade by placing our stop loss above the breakaway gap. This way our stop loss will be less likely to get triggered in the market fluctuation. So again, when the market is in the middle of the move, there it will be likely to occur a runaway gap, which usually appears at the 50% move of the trend. And similarly to the breakaway gap, the runaway gap will also be not likely to be filled instantly. And if the market approaches this gap instantly, it will act as a resistance. So again, we can enter in the market, we can open the trade, we will place our stop loss above the runaway gap. And the final one is the exhaustion gap. The exhaustion gap is likely to be filled instantly because the trend will reverse, and the trend can reverse at any point and at any time. So we can anticipate this gap to be filled instantly, and sooner when the exhaustion gap appeared, we saw the market again made or formed a major price pattern and reversed its direction to the upward movement. So again, I showed you all the examples on the chart of all the bullish examples on the chart. I will leave it out to you guys to find the bearish examples of these gaps and how to trade these gaps in a bearish trend. So consider it as your homework. See you in another video. Take care.